In the 1990s, the rhythmic description of a diamonique ring or a new air fryer became the ambient sound of American domestic life. This background noise was the front-facing side of a highly specialized retail machine. Behind the host's smile was a sophisticated direct-to-consumer engine. By May 2025, that engine was issuing going concern warnings, struggling to maintain its Nasdaq position. QVC bypassed the friction of 20th century commerce. By beaming a storefront directly into homes, they eliminated massive overhead costs of real estate, staffing, and physical inventory of traditional department stores. This graph illustrates the scale of that dominance. The steep upward curve tracking their multi-billion-dollar revenue growth in the late 90s is suddenly intersected by a sharp, cliff-like drop in equity value by 2025. To understand the modern e-commerce landscape, you have to look at the moment this growth line flattens out and begins its descent into the negative axis. The pioneer of live shopping is now facing the collapse of the very model it invented. QVC provided the original blueprint for the modern internet economy. Its current fight for survival is a case study in how the most dominant market capture can become a liability when the medium of distribution shifts. In 1986, entrepreneur Joseph Segal launched the network based on a three-word acronym: quality, value, and convenience. Segal's primary strategy involved a departure from the high-pressure tactics found on standard sales floors. He implemented a philosophy known as the soft sell. Hosts were trained to act as friendly guides rather than aggressive salespeople. They spoke to the camera with a conversational tone, building a sense of personal connection with the viewer. This technique reduced customer resistance and established a level of brand trust that traditional retailers, with their rotating floor staff and sterile environments, could not replicate. This model allowed the network to reach a national audience from a single location. While department stores were burdened by the property taxes and utility bills of hundreds of locations, QVC operated with zero physical retail footprint. By combining a high-margin product mix with televised companionship and minimal overhead, Segal built a high-margin financial engine decades before the rise of digital shopping. By 1987, the network ramped up to broadcasting 24 hours a day, 7 days a week. This continuous feed ensured the brand was a constant presence in millions of American households, turning a niche cable experiment into a cultural fixture. During the 1990s, the company aggressively acquired and absorbed its early rivals, including CVN, to eliminate competition in the televised retail space. To protect their profit margins, they moved into exclusive celebrity partnerships and proprietary in-house brands that could not be price compared at other retailers. In 1997, they consolidated these operations into the massive Studio Park headquarters in Westchester, Pennsylvania, a 160-acre facility dedicated to 24-hour sales. By the end of the decade, QVC had moved from a small-scale experiment to an untouchable, monopolistic cash flow powerhouse. This dominance culminated in a massive corporate transaction in 2003. John Malone's Liberty Media took full control of the network, buying out Comcast's share for $7.9 billion. Malone viewed the network as a highly reliable asset. At its peak, it was a cash flow engine that operated with incredible consistency. In 2003, the company's 24-hour reach made it appear insulated from early rising threats of e-commerce. This $7.9 billion valuation established QVC as the primary financial asset powering Liberty Media's global portfolio. By May 2025, that period of market dominance had been replaced by clinical corporate dread. Qurate Retail Group is now issuing going concern warnings to its investors, signaling that the company's current financial reality is no longer sustainable. The company is currently taking extreme accounting measures to maintain compliance and avoid being delisted from the Nasdaq. The pioneer of live shopping is now an underdog. To find an audience, they are forced to seek distribution on TikTok, the same platform currently using the sales tactics QVC pioneered 40 years ago. They are struggling to reach the very demographic that once defined their customer base. As the business model they built is occupied by newer, more agile competitors, their path forward is increasingly locked in place. QVC is not expanding into a new era. It is a business attempting to survive the end of the era it was built to define.
For decades, QVC operated as a retail machine, generating billions by turning millions of living rooms into high-volume sales floors. But as the 2010s advanced, consumer habits shifted. Shoppers turned to their smartphones, and cardboard boxes began piling up on doormats as digital platforms mastered rapid, direct-to-consumer delivery. QVC's massive advantage relied entirely on a specific piece of infrastructure, the default cable bundle. Millions of consumers were tied to this physical hardware, providing the network with a vast captive audience. When cord-cutting began, the company didn't forget how to sell. The hosts remained engaging, and the product line stayed active. The problem was that the environment that made their business model effortless was disappearing. Viewers were physically abandoning the hardware and formats of scheduled broadcast television, treating the medium as obsolete. Facing this environmental collapse, leadership authorized $4.5 billion in acquisitions to fix the problem. Instead, they exhausted their capital trying to preserve a model tethered to a failing distribution network. By August 2015, the steady erosion of cable viewership forced executives to make a major move. They deployed $2.4 billion to purchase the online retailer Zulily. The strategy was driven by demographic expansion. Leadership wanted a younger, mobile-first audience that QVC's traditional broadcast model could no longer reach. On paper, the logic appeared sound. Executives calculated that combining their own expertise in live video production with Zulily's digital flash sale mechanics would yield massive returns. Financial projections suggested the two models would integrate seamlessly, but the spreadsheets ignored the day-to-day friction of actual operations. Over 3 decades, QVC had engineered a deeply specific retail model. It relied on high-touch storytelling, where hosts developed long-term, trust-based relationships with regular viewers. Zulily operated on a strictly transactional basis. Their member-only structure prioritized rapid turnover and deep discounts. Attempting to merge relationship-driven broadcasting with algorithmic discount e-commerce simply resulted in a massive operational clash. The core demographics of each brand valued entirely opposite experiences. QVC shoppers tuned in for the narrative. Zulily users logged on solely for the lowest possible price. Cross-pollination never materialized. Rather than driving digital adaptation, the acquisition became a heavy anchor. The two models refused to integrate, pulling down overall corporate profitability. Following their digital misstep, leadership retreated directly back to the traditional television studios they understood. In July 2017, they initiated a $2.1 billion all-stock transaction to acquire the remaining stake in their longtime rival, the home shopping network. The strategy shifted to defense. By consolidating the linear television market, executives aimed to strip out hundreds of millions of dollars in redundant operational costs. This chart shows the acceleration of pay TV subscriber losses across the industry. In 2017, the exact year of the HSN merger, the pay TV ecosystem lost about 1.5 million subscribers. By 2018, those losses doubled, with cord-cutting spiking to 2.9 million abandoned accounts. Executives spent billions to capture total control of their market, permanently tethering the company's future to a distribution medium that was actively collapsing. In 2018, the company rebranded as the Qurate Retail Group, attempting to signal a modern, curated era to an increasingly skeptical investor base. A new corporate logo did nothing to halt the structural decay of their distribution network, nor did it replace the billions in capital they had already spent. Then, a series of severe macroeconomic shocks struck in 2019, hitting a company that was now too weak to absorb the impact. Sudden tariffs levied on Chinese imports directly attacked their highly optimized yet fragile cost structures. Simultaneously, widespread global supply chain disruptions erased the company's remaining profit margins. With acquisition costs high and shipping delayed, it became nearly impossible for QVC to deliver on the value portion of its foundational brand promise. By spending $4.5 billion on mismatched acquisitions and a fading medium, leadership had stripped the company of the capital and agility needed to weather these compounding crises. The force tearing QVC apart today has nothing to do with Amazon. It is an internal crisis, a crushing mountain of debt colliding head-on with a technology pivot that arrived years too late. This chart tracks Qurate Retail Group's stock value from 2021 to 2025. It is a sustained collapse that removed billions of dollars in shareholder wealth from the market.
When a stock loses value this rapidly, it attracts deep value investors looking for distressed assets. Michael Burry's decision to take a stake in the company served as a warning to the market that QVC's financial health reached a critical state. For anyone managing a retail portfolio, this timeline shows how quickly a legacy brand can move toward penny stock territory. If management misreads a digital shift, even a household name can become a liability almost overnight. In late 2021, David Rawlinson II became CEO. He inherited a company defined by heavy leverage, expensive physical infrastructure, and a core television audience that was steadily shrinking. Management responded in June 2022 with Project Athens. This was a 3-year strategic plan centered on a massive target, finding $600 million in annual cost-based reductions to keep the business afloat. The strategy faced a massive financial hurdle. Transitioning to a streaming-first model requires significant capital, money that Qurate was already using to service its existing debt and maintain its legacy cable operations. To bypass the slow process of building a new audience, the company had previously acquired Zulily. It was a multi-billion-dollar attempt to buy immediate access to a younger, digital native demographic. The acquisition failed to stabilize the business. By May 2023, Qurate sold Zulily to an investment firm at a loss, and the brand entered total liquidation just 7 months later. This failure illustrates that acquiring a digital brand cannot repair a balance sheet if the parent company's core retail model is losing its relevance. By 2024, Qurate was squeezed from both sides. While revenue was dropping in the double digits, the company was still forced to manage its ballooning debt and significant tax liabilities. The damage became clear in the first quarter of 2025, with revenue dropping 11% to $2.3 billion. Internal efficiency also eroded. Operating income fell by 25%, meaning significantly less profit on every dollar brought in. In early 2025, the company reverted to the QVC group name. It was an attempt to simplify the narrative for investors by focusing strictly on the core television brands, QVC and HSN. This was a cosmetic change. Rebranding is an aesthetic solution for a financial problem, and it did nothing to address the underlying debt. By May 2025, the stock was trading near 10 cents. To avoid being delisted from the Nasdaq, the board executed a reverse stock split, a move intended to keep the shares tradable on a major exchange. A reverse stock split is a technical maneuver that buys time. It changes the share count to increase the price, but it does not address the fact that the company's audience is no longer showing up. Financial restructurings can hide the symptoms of a decline, but they simply cannot fix a broken consumer pipeline. QVC is now trying to catch up to an audience that has already moved from the living room to the smartphone. They've expanded onto TikTok Shop and streaming platforms like Philo, attempting to replicate their live selling model for a mobile-first generation. They are no longer the primary destination for home shopping. In the digital era, they are one of thousands of brands competing for a fraction of a second in a user's feed. This is a sharp contrast to their peak years. When television was the primary screen, QVC held a near monopoly on the living room. The company's original values are still there, but the convenience part of their name is now controlled by tech companies that didn't exist when the first QVC cameras turned on. Dominance tied to a specific technology can quickly become a liability. When that distribution method shifts, as it did from the television to the scroll, the infrastructure that once ensured market control turns into an anchor. The financial pressure reached a legal turning point by the third quarter of 2025. In their mandatory SEC filings, the company used the specific phrase substantial doubt to describe their ability to continue as a going concern. This should prompt an audit of your own holdings. Identify any companies in your portfolio that rely on outdated forms of technological convenience for their market share, and evaluate if they can survive. QVC is a testament to the power of Joseph Siegel's original idea, but its current state is a warning. It shows the cost of maintaining a legacy model long after the market has moved elsewhere. Which legacy retailer do you think is next to face this kind of decline? Tell us your thoughts in the comments. If you found this analysis helpful, like, subscribe,